And in today's Money Minute, we're taking another look at today's closing numbers. The Dow down nearly 400 points or 2.4%. The Nasdaq also closed down more than 125 points.
Well, this January has been the worst start for the stock markets here in the U.S. in modern history. And for more analysis on this, we're joined now by Joel Naroff, president of Naroff Economic Advisors and the managing director of Absolute Investment Management, Bob Wiedemer, also the best-selling author of Aftershock. Gentlemen, thank you so much for being with us here on Newsmax Now.
Pleasure being
here. Thank you, John.
Bob, first to you, it's been, as John just mentioned, a very rocky start to the new year, with some worried we could actually be headed for a legitimate recession. Do you think that's likely? And if so, what are the main economic factors that will lead us there?
Yeah, I'm not sure we're actually going to go into recession, but there certainly are some indicators that it's going to slow down and get close. Mostly, if you're looking at transportation, manufacturing, obviously the oil industry, all of those are the kind of things that are forcing the economy to slow down. We haven't seen it in jobs yet, I know, but certainly there's those forces are the key ones in my mind. Manufacturing, oil industry are pushing us down. And we never had very good growth to begin with, so it's not that hard to push us down to near zero.
Well, you mentioned jobs there, Bob, but Joel, we heard from Walmart announcing today they're shutting down, I think, 250 stores, maybe more than that, laying off thousands. And CEO Doug McMillon is reviewing Walmart operations and shutting down more underperforming stores, perhaps. Other retailers could follow suit there. But you say overall, though, things in the consumer sector are pretty strong, and you remain bullish on the economy. Tell us why.
Well, absolutely. I think even with the Walmart story there, what's happening is a restructuring that's going on. Walmart even, said that a lot of those employees will probably be able to find jobs at full-service Walmarts, which are not far away. So I'm not necessarily that concerned about it, especially since the retailing sector is changing so dramatically with internet sales going on. So what may be lost in Walmart may be picked up in some of the distribution internet-related kinds of companies. But most importantly for me, as far as the economy is concerned, is the labor market. It's tight. We're pretty much at full employment. Wage gains are accelerating. We've gone from 0.5% 2 years ago on hourly wages to 2.5% last year. We're looking at income growth. Confidence is rising. When you have 2/3 of the economy that's doing well, getting better, being confident, buying automobiles at rates we've never seen, that tells me this economy is in good shape. One quick other point. We're not growing at a weak pace. We're growing at trend growth, and we keep forgetting that. Trend growth is about 2.25. We did that last year. We'll probably do more than that this year.
Bob, I want to get your take on that, because we've heard a lot of people actually criticize these job reports, saying that they're not really painting an accurate depiction of what's going on in our economy, that some of these jobs are seasonal, that they're not really good paying jobs, or people have just given up looking for work altogether. So in response to what Joel just said, do you agree to that?
Well, I certainly agree that the jobs picture is not as rosy as the numbers paint. It's still we're clearly adding jobs, and some of those are clearly full-time jobs. But yeah, the big issues is that the labor force participation rates have continued to decline, although that's flattening out now, but it's still declined significantly. And wage growth has not been good. And in fact, it's been almost non-existent. Now, I'd say that's not exactly a problem we've had just in the last few years. That's a longer-term problem the country's faced, but it's still a problem. And one reason that 2% growth really isn't that good. And let's keep in mind that when you add in the massive amount of government borrowing and stimulus from that, I would say stimulus adjusted, you're not getting much growth. We're still going to borrow over $400 billion this year as a government, and that has to be offset against the growth we're seeing in the economy, which is larger than that, but not that much larger than actually what we're borrowing as a government. So stimulus adjusted, growth is not good at all.
All right, we also showed, in addition to the equities, Dow, the Nasdaq, and the S&P, we also talked about oil in the beginning of this. Oil dropping now below $30 a barrel. For drivers, it's great. That means more money for consumers. But Bob, is this a sign of more trouble to come when demand could be low and there's a glut of oil?
Well, there's no question there's a glut of oil. And we have potentially sanctions coming off Iran next week, which isn't going to help as they ramp up their production over the next year. No, I've said before, and I say again, that oil is going down. It's going down lower, likely below $20 a barrel. And unlike most of the oil industry, I don't think it's going to jump back up to 60 by the end of next year. Oil industry seems to have forgotten history. In the 1980s, we had the same issue. We had a big boom in the oil industry in the 1970s, lots of drilling. We cut our drilling rates massively in early 80, and we still saw oil falling from about $37 a barrel in 1981 to about $10 in 1986. This stuff doesn't go away fast. It's going to take a while for oil prices to rebound and for the oil industry to recover.
All right, that's why they talk about these cycles in the economy, right? Bob Wiedemer, thanks so much for joining us as well. Joe Naroff, gentlemen, it was an enlightening conversation.
Thanks.
Coming up next, Newsmax TV will broadcast Donald Trump's live event this Monday morning starting at 10:30 a.m. Eastern Time. You don't want to miss that. Also coming up in today's Newsmax Now headlines, Chipotle plans a temporary shutdown next month, but only for a few hours. We'll explain.